So we are reading the basic accounting term chapter 2. So in this chapter we are reading the chapter 2. In the business, various accounting terms are used. It is necessary to understand in a term that they are a part of a standard accounting terminology. First, of business transaction. In term of business transaction means a financial transaction or event entered into two parties and is recorded in the book of account. It is a financial event expressed in a term of money which brings change a change in the financial position of enterprises. It's an agreement between two parties involving the transfer and exchange of a good or a service. For example, of a business transaction or sales of goods and the purchase of goods received from the debtor, payment to creditor, and the purchase or sale of fixed assets or payment of interest or dividend exit. Business transactions, any type of transaction, we should be tell that it's a business transaction. Characteristic of transaction: it is concerned with money or a money worth of a good or a service, and it arises out of the transfer or exchange of good or a service. It's bring about the change. It is a financial position, assets or liability. It has an effect on the accounting equation. It's a dual aspect of two-side debit or credit. So transaction two types of relation with accounting unit and mode of settlement of value. Internal transaction or accounting transaction, example depreciation or fixed assets, and external transaction or business transaction. इंटरनल और एक्सटर्नल टू टाइप ऑफ रिलेशनशिप विद अकाउंटिंग यूनिट में दो टाइप होगी, इंटरनल ट्रांजेक्शन एंड एक्सटर्नल ट्रांजेक्शन. मोड ऑफ सेटलमेंट ऑफ वैल्यू ट्रांजेक्शन, कैश ट्रांजेक्शन और क्रेडिट ट्रांजेक्शन. A transaction may be cash transaction or a credit transaction. Both can be possible. When the amount transaction immediately entering into transaction, it is a cash transaction, and when it promise to pay later, it a credit transaction. Obviously it's very easy. If you are paying the exact the amount in immediately, that was a cash transaction, and you pay later, that credit transaction. Transaction may be extended between the business entity and the second party. For example, the goods sold on a credit to Z, okay, to Z, and or internal does not involve a secondary party like a depreciation charge or a machinery. Example. Second is accounts is a summarized recording of transactions relating to the particular had at one's place. It's recorded only the amount of transaction but also their effect and direct. For example, purchase of goods, whether cash or credit are shown as a purchase of goods. Yeah, because we purchase of goods, entry we could done purchase account debit to Mr. X. He is not paid the amount, then we say Mr. X. And if they give the amount in a cash, so we done the entry purchase account debit to cash. Okay. Capital is the amount invested by the proprietor or a partner in the business. It's maybe in the form of money or assets having a monetary value. It is the liability of business toward the proprietor or a partner, which increase the further investments made in the business and the amount of a profit. And on the other hand, it decrease when it's a drawing or a loss incurred by the business. In the case of companies, the company capital is contributed by many and they are known as the shareholders. It is considered as a liability because under business equity concept, a business is separated and distinct entity from its owner. Transactions are recorded in the book of account from the point of view of business, and capital is also known as owner equity or net worth. Yeah, we can say the capital, another name is owner equity or net worth. They both are sides. Okay, it's always equal to the assets less liabilities can be expressed as a capital equal to asset minus liabilities. Drawing. It is an amount to withdraw or a goods taken by the provider or a partner from the person used. The goods are taken. So taken by the proprietor or partner a value at a purchase cost. Drawing reduces the investments or capital of the owner, and drawing by the proprietor or a partner is debited to the drawing account. Okay. Again, we have to read that because it's a little bit. It is the amount of withdraw or good taken by the proprietor or a partner for personal use. Correct. Good are taken from the proprietor or partner value at a purchase cost. And drawing reduces the investment or capital for the owner, and drawing by the proprietor or partner is a debited drawing account. At the time of preparing balance sheet, it is deducted from the capital of the proprietor or partner as the case is. Liability. Liability means amount owned payable by the business. Liability towards the owner of the business in a term of internal liability. On the other hand, liability towards the outsider other than the owner in term as external liability. External liability arises because of credit transaction or loan taken. Example of external liability are creditors or bank overdraft, long-term borrowings, and other liability. Liability can be further classified into two: current liability. Non-current liability is that liability which is payable after a period of more than 1 year, and more than a year from end of the accounting period. For example, non-current liability is are long-term loan, debentures, etc. Current liability is the liability which is payable within a 12 month from the end of the accounting period. Example of current liability are creditors, bills payable, and short-term loan, etc. Classification of liabilities in case of companies for Schedule 3 of Companies Act 2013. The liability schedule is classified current liabilities, non-current liabilities. Current liabilities are liability of current liabilities satisfy one of the following. It is aspect by the settled by the company normal operation cycle. It has primarily from the purpose of being traded. It due to settle within 12 months after the reporting date. The company doesn't have an unconditioned right to defer settlement of the liability for it at least 12 months after the reporting date. Same. Non-current liabilities. Non-current are those liabilities which are not current liability. Operation cycle means the time between acquisition of an asset, processing, and it conventional into cash and equivalent. If the operation cycle can't be identified, it is taken by the period of 12 months. Company accounts is the part of syllabus of class 12. Assets are the proprietor, tangible assets, intangible. Two types of assets owned by a business. There are the economic resource of business and the other thing. Which will enable to the firm get cash or economic benefit in the future in an asset. Example of asset or land, building, machinery, furniture, stock, debtor, cash and bank balance, trademark, right, goodwill, etc. Assets are the future economic benefit. The right which are owned or controlled by an organization individual. Assets are properly or legal right owned by individual company to which money value can be attached are broking tone. Asset or value resource owned by business which are acquired at a measurable money cost. What emerged for the above definition is that assets should have the following characteristics. It should be owned by the business. It may be tangible, means physical from or intangible. It should be some value attached to it, and it should be capable of being measured in a money term. Asset can be classified into two current non-current assets, current assets, fictitious assets. Non-current assets are those assets which are held by a business not with the purpose to resale but are held either an investment or to facilitate business operation. In other words, those assets are held by the business from a long-term point of view. Example of non-current asset are fixed asset, non-current investment, long-term loan and advance, and the other non-current asset. Fixed asset are those current asset of enterprises which are held not to resale but the purpose of increase the earning capacity. Fixed assets are further classified tangible, intangible. Tangible assets are those assets which are physically existent. They are can be seen, touched, or example of tangible asset land, building, machinery. Intangible is those assets which do not have a physical existence. They can't be seen and touched. Example, intangible assets are patient, goodwill, trademark, computer software, that all kind of intangible. Current assets are those assets which are held by the business with the purpose of converting them into cash within a short period. 1 year. For example, goods are purchased with the purpose to resale and earn profit. Debtor exists to convert them into cash and to receive an amount fix them. The receivables exist again receiving cash against in etc. Repair expenses are also classified as a current assets, all through they can't be converted into cash. They are so classified because a particular of the benefit from such expenses is available in the next accounting year. Fictitious assets are those assets which are neither tangible assets nor intangible assets. These are loose, not written off in the year in which they are incurred, but in more than one accounting period. In the case of firm, an example of fictitious deferred revenue, expenditure, discount, or loss on issue of debenture. An example of fictitious asset in the case of companies. Classification of assets in case of as per Schedule 3 of companies. Classification of the assets in the case of a companies are as per Schedule 3 of the Companies Act 2013. The assets like the liabilities are classified by the Schedule 3 and the Companies Act 2013. The current assets and the non-current assets, they are defined as follows. The current assets and assets is a current assets if it is satisfied any one of the following criterias. It is expected by to be realized in or intended by for sale or consumption in the company normal operating cycle, or it is held primary for the purpose or being trade, or it is expected by the realized within 12 months for the reporting date, or it is cash and cash equivalent unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. Non-current assets. Non-current assets are those assets which are not current assets. Operating cycles means the time between the acquisitions of an asset for processing and its conversion into cash and cash equivalent. It is if the operating cycle can't be identified, it is taken to be period of 12 months. Receipt. Receipt is the amount received and received for selling assets, goods, or a service. Receipts are further categorized into revenue receipts and capital receipts. Revenue receipts, it is the amount received or receivables in the normal course of business, say against the sale of good and rendering of services. Example of revenue receipts are amount received and receipts against sale of good and rendering of service. Interest on fixed deposit or investment etc. Capital receipts, it is the amount received or receivable against a transaction which are not revenue in a nature. For example, amount received or receivable for the sale of machinery, building, furniture, investment loan, etc. Expenditure. Expenditure is the amount spent on a liability incurred for in acquiring assets and a good or a service. Expenditure may be categorized into capital expenditure and revenue expenditure. Deferred revenue expenditure, that kind of expenditure is here. Capital expenditure, it is an expenditure incurred to acquire asset or improving the existence asset which will increase the earning capacity of the business, will give benefit of enduring nature of the business. It may be incurred to acquire tangible assets or intangible assets. For example, capital expenditure are purchase on machinery to manufacture good, purchase of furniture, computer to carry on a business. Capital expenditure is shown on the asset of side of the balance sheet. Or revenue expenditure. Revenue expenditure is the expenditure incurred the benefit of which is consumed or exhausted within the accounting period. It has a direct relationship with the revenue or with the accounting period. Example, cost of goods sold, salaries, rent, electricity expense, etc. Revenue expenditure is shown on the debit side of the trading account or profit and a loss account in the case of firm, in the expenses part of the statement of profit and loss in case of company. Deferred revenue expenditure. Deferred revenue expenditure is the revenue expenditure in nature, but it's a return of charges in a more than one accounting period. For example, large advertising expenditure that will be given benefit for more than one accounting period and deferred revenue expenditure. Expenses. Revenue. Revenue means the amount which, as a result of operations and the sale of the good and the service, is added to the capital. Revenue is a gross inflow of cash, receivables, or other consideration arise in the course of ordinary activities of of the enterprises for the sale of goods for rendering of services from the use by other of enterprises resource yielding interest and dividend equity. Example of revenue are received from sales of goods and rent commission etc. Revenue differs from the income and the sale of a good and the service in the revenue. The cost of sale of good and the service is an expenses. The difference between revenue and expenses is the income. Income is equal to revenue minus expenditure because how we calculate the revenue, how many we put how amount we put in a business and how the amount we get uh, from the business. If we calculate the both of this and minus the revenue minus expenses means how we get and how we put in a business, so both we subtracted the income. The positive amount will be came in the income and the negative came at this is loss. Ninth, expenses the cost incurred for generating revenue. According to R.N. Anthony, expenses is a monetary measure of inputs and the resources consumed. Is a value which has expired during the accounting period. It may be cash payment such as salaries, wages, rent, etc., and the writing of the part of a fixed assets depreciation. An amount written off out of current assets, say bad debts, decline in the value of assets, say investment, cost of goods sold. Means cash payments such as salary, wages, return of part fixed assets, or amount written off current assets, bad debts, decline in the value of assets, investments, and COGS. And expenses is a charge debited to trading account and profit and loss account. Prepaid expenses, it is the expenses that has been paid in advance, the benefit of which will be available in the following years or years. So for example, insurance premium 10,000 has been paid 1 year beginning 1st October 2014. The financial year ends in the 31st March 2015. It means the premium for 6 months. The first financial year ends 31st March 2015. It means the premium for the 6 months. The financial year ends 31st premium 6 months, and April 2014 to 30th September 2015. The amount of the 5,000 is paid in advance. So the amount of a premium paid in advance, if rupees 5,000 is prepaid expense, it will be accounted as an expenses in the financial years ending 31st March 2015. Outstanding expenses, it is expenses that have been incurred but has not been paid for. An example, an account audit has been conducted by the chartered accountant firm against which audit fee of rupees 20,000 is to be paid. It means a liability for rupees 20,000 has been incurred which is yet to be paid, and it termed and outstanding expenses. It is debited to the profit and loss account and also show under the head of current liabilities in the balance sheet. Income is the profit earned during a period. In other words, the difference between revenue and expense is termed as income. It is a broader term than the term profit and includes profit from the activities other than its operating activities. For example, good costing 15,000 are sold for 25,000, and the cost of goods sold 15,000 is expense, that's the sale of goods. 21,000 is the revenue, and the difference is 6,000 in income. It can therefore be expensed as 11. The profit means the income earned by the business from its operating activities. The activities carried out by the enterprises to earn profit. Profit is a further dividend into gross profit and the net profit. The gross profit is the difference between revenue from sales or service rendered over its direct cost. A net profit is the profit earned from the allowing all the expenses. In the case of expenses is more than the revenue, it's a net loss. Gain, it is a profit of irregular or non-recurring nature. It is a profit that arises the transaction where are operating activities of the business but are incidental to it, such as a gain on the sale of fixed assets or investment. Loss is the excess of expenses over period over its revenue, and it's to increase the owner's equity. It's a board term including loss incurred in its operating business activities, money or money worth loss against which the firm receives no benefits. Example, cash or goods loss in the thefts and losing rising from the events and of non-current nature, and loss on sale of fixed assets. Purchase, the term of purchase is used for the purchase of resale or it's producing the finished product which are also to be sold. So the term purchase including both cash and the credit purchase of goods. So goods purchase for the cash are termed to cash purchase and the good purchase on their credit are termed as a credit purchase. Purchase returns, the good purchase may be returned to be sold for any reason, say they are defective. Goods are returned are known as the purchase returns and return awards. Sale, the term sales is associated with or used for sale of goods that are dealt with the what is the meaning of dealt with the firm. The term sale including both cash and credit. The goods are sold for cash and they are cash sale, and when sold on a credit they are termed in credit sales. Sale return, goods sold returned by the purchaser are termed as a sale return or good return inwards. Goods are physically in term of trade that apply of all the items make up the sale or purchase of a business. So they are thus stock in a trade of enterprises much which are purchased or malfunctioned manufactured with the purpose of selling for an enterprises dealing in home appliances such as TV, fridge. But stock inventory is intangible assets held enterprises for the purpose of sales in ordinary course of business for the purpose of using it in the production of good meant for sale. Stock inventory may be opening stock inventory, closing a stock inventory. Opening stock inventory is the stock in a hand in the beginning of accounting year. In other words, is stock in hand at the end of previous accounting year. Closing stock inventory is the stock at the end of current accounting year period. Stock or inventory may be in the following kinds: stock or inventory of goods. Stock, goods, or inventory in case of traditional concepts comprises stock inventory of goods and many unsold. In case of manufacturing concern, it's processed good manufacture for the purpose of sales. It is value at a cost or net realizable value, whichever is lower. Stock or inventory of raw material, it compromises the stock of raw material used for stitching shirts. It is value at a cost or net realized value, whichever is the lowest. Work in a process. It is a stock that is in the process of being finished, that are the partly finished goods. It is the value at aggregate of cost of raw material used, the cost of labor, other production, and power, fuel, etc. Stock or inventory is classified in the balance sheet as a current asset. It is the value on the basis of cost or net realized value, marketable price, whichever is the lower principal. Trade receivable, it is the amount receivable for the sale of good or a service rendered in ordinary course of business. Trade receivables is a sum total of debtor and bill receivables. Debtor, debtor is the person who owns amount to the enterprises against a credit sale of good and service in its ordinary course of business. For example, when goods are sold, goods are sold to the person on a credit. That person is called debtor because he owns the amount or to the enterprises. The amount due to no debt and bill receivables. Bill receivable means the bill of exchange except the debt and the amount of which. Trade receivables is the amount received for the sale good and render in the ordinary course of business. A trade receivable is the sum total of debtor and bill receivables. A debtor is the person who owned amount of enterprises against a credit sale of good or service in the ordinary course of business. For example, when goods are sold to the person or credit, that a person is called a debtor because he owns the amount of the enterprises. The amount due to no is known as a debt. Bill receivables means the bill of exchange accepted by a debtor. In trade of receivable, bill receivables replace a debtor. Trade payables is the amount payable for the purchase of good service taken in the ordinary course of a business. And the trade payables is the sum of total of credit and the bills payable. So credit is the person to whom an enterprises own against credit purchase of good and service taken from. An example, Mohan is a creditor of a firm when a good are purchased from the him or the credit. Bills payable means the bill of exchange accepted from the amount of which will be payable on the specific date. It is included in a trade payables because the bills payable replace a creditor. Trade payables are defined in the Schedule 3 of Companies Act 2013. The trade payables is the amount payable against a good purchase and services taken in the normal course of a business. Cost, it is the amount of expenditure included on or attributable to the specified article, product, or activity. Vouchers is an evidence of a business transaction. Example of voucher are cash memo, invoice, or bill receipts, debit, credit notes, etc. Discount, when customer are own debate in the price of good by the business or from the amount paid by the customer. It is known as a discount. Trade discount. Trade discount is a rebate allowed by the sale on the basis of sale, either quantity or value. Sale are recorded at net value and sale. Trade discount, similarly purchase are recorded by the purchaser at net value. Purchase is trade discounts. Cash discount is the rebate allowed by the timely payment of due amount. It is the expenses for the party allowing the discount and income for the party receiving cash discounts. It is recorded in the book of account for both the parties. Book of account are those books in which transactions are recorded and included: cash book, bank book, general proper ledger. Entry, A transaction event when recorded in the book of account is known as an entry. Debit an account has a two-part, debit and a credit. The left side is the debit side, while the right side is the credit side. Left side is the debit, right side is the credit. It is an amount to be debited, then the entry is posted to the debit side of the account. In such as an event, it is said to that the account is debited and it has been derived from the Italian word debito. Debito. Okay. Credito is the credit side of the account, that is account is to be credited, and the entry is posted for the credit side of the account. It is such as an event. It is said that the account is credited. It has been derived from the Italian word credito and debito credito. Both are the debit and the credit sides. Proprietor, the person who makes the investment on the bears all the risk associated with the business, is called a proprietor. Depreciation is a fall in the value of asset because urge or with a flux of time, obsolescence or accidents. It is an allocated of cost of each asset in each accounting year during its expected useful life. Cost of goods sold. So cost of goods sold is the direct cost attributes to the product of goods sold on a service rendered. Bad debts. Bad debts is the amount owed to the business that is written off because the incoverable. It is a loss for the business and is thus debited to the profit and loss account. Insolvent, it is a person, enterprises which is not in a position to pay in debts. Solvent is the person or enterprises which is in a position to pay its debts. And book value, it is the amount which an item appear in the book of account and the financial statement. Balance sheet is a statement of a financial position of an individual enterprises at a given date, which exhibits its assets and liabilities, capital reserve, and other account balance at their respective book value. Entity means an economic unit which perform economic activities. For example, Reliance Industry, Bajaj Automobile, the entities and business entity means an enterprise. According to the law of doing business activities, this includes proprietorships, firms, partnership, corporate form. Accounting is devised for a specific business entity called accounting entity. So this chapter is completed. If you like the video, and do like, subscribe and share. Thanks for watching.